The history of the financial markets in the 20th century is not a simple timeline of events. It is the chronicle of a great intellectual duel. At its heart lies a single, fundamental question. Is the market a mechanism for speculating on ephemeral price movements? Or is it a vehicle for the long-term ownership of intrinsic business value? The answers to this question have defined entire generations of financiers, creating vast fortunes and equally vast ruins. The two men who represent the polar opposite answers to this question are Jesse Livermore and Warren Buffett. One, the most brilliant speculator who ever lived, a master of timing and the chaotic pulse of the tape. The other, the most successful investor in history, an icon of patience and the power of compounding business value. This is not the examination of a simple evolution. It is the analysis of a dialectic, a clash of powerful, competing philosophies. We will trace the intellectual lineage from Livermore to Buffett, showing how each successive figure did not merely refine the ideas of their predecessors, but often stood in direct refutation of them. Each new strategy was forged in the crucible of the previous generation's failures, a direct response to a changing economic environment, and a deeper understanding of the market's unforgiving nature. This is the narrative of how the very concept of building wealth in the markets was deconstructed and rebuilt, idea by powerful idea. To build this foundation of strategic thinking, there is no greater resource than the one book read by nearly every market master. Edwin Lefebvre's classic Reminiscences of a Stock Operator. It is the thinly veiled biography of the first figure in our intellectual duel, Jesse Livermore. To help you absorb its timeless lessons on market dynamics and mass psychology, we've linked in the description a unique chapter-by-chapter analysis by Max Davidson, specifically designed to translate its century-old wisdom for the modern trader. Consider it required reading to understand the speculative thesis, the foundational argument against which all subsequent figures would react. The intellectual duel begins with the first proposition, the thesis of pure speculation, perfectly embodied by Jesse Livermore. To understand Livermore's strategy, one must first understand his environment. He operated in the pre-SEC world of the early 1900s, an arena of rampant manipulation, opaque financial reporting, and unregulated brokerage houses known as bucket shops, which were essentially gambling parlors that took bets against their clients. In such a world, traditional fundamental analysis was not just difficult. It was often a trap designed to lure in the unsuspecting public. Corporate insiders and powerful market pools, syndicates of wealthy operators, could paint any picture they wished, engineering price movements to fleece the masses. For Livermore, this context dictated that the only source of verifiable truth was the price action of the stock itself, as recorded on the ticker tape. The tape, he reasoned, was the final arbiter of supply and demand. It reflected the sum total of all buying and selling, both informed and uninformed, and it could not lie or be falsified in the way a company's books could. This led to the first pillar of his doctrine, the primacy of price and trend. His goal was not to buy undervalued assets, but to align himself with the dominant market force, what he called the line of least resistance. He would remain patiently on the sidelines, often for months, with his capital in cash, waiting for the market to signal its next major move. This signal was the pivotal point, a critical price level, often a new all-time high after a long consolidation, where a breakout would confirm that a new, powerful trend was underway. He believed that buying at the pivotal point was the safest, not the riskiest, time to enter, as it represented a market-validated shift where demand had definitively overwhelmed supply. Once the trade was on and had proven itself profitable by moving in his favor, Livermore employed his most powerful tactic, pyramiding. He would add to his position in increments as it continued to advance, building a large line of stock with a very favorable average cost. This method of controlled aggression was designed to maximize gains from the large, multi-month trends that he believed were the source of all real money in the market. However, operating in such a volatile environment required a defense mechanism of equal power. Livermore's risk management was brutal and absolute. He held that a speculator's greatest enemy was hope, and his rules were designed to surgically remove it from the equation. His famous 10% stop-loss rule was non-negotiable. Any position that moved against him by that amount was sold without question or hesitation. He famously stated, "The stock market is never wrong, opinions often are, and losing money is the least of my troubles. A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul." This philosophy stood in stark opposition to the amateur's mistake of averaging down on a losing position, which he considered a cardinal sin. His legendary short sales before the crashes of 1907 and 1929 were the ultimate expressions of his method. In 1929, he observed the classic signs of a topping market: narrowing leadership where only a few key stocks were driving the averages higher, speculative froth in low-quality names, and climactic volume that failed to push prices higher. He patiently built his short positions during the market's final sputtering rallies, enduring immense psychological pressure before the eventual collapse made him one of the richest men in the world. Yet, the very nature of his strategy, relying on the flawless timing and psychological fortitude of a single operator, contained the seeds of its own destruction. It was a high-wire act that was ultimately not transferable and led to his ruin, proving the need for a system that could protect against human fallibility and the randomness of fate. Building a trading career is about instilling the right habits from day one. As the philosopher Aristotle taught, we are what we repeatedly do. Excellence, then, is not an act, but a habit. The habits Jesse Livermore forged, the immediate cutting of losses, the patient waiting for a proper setup, the refusal to act on hope, were the very source of his excellence. For any aspiring market operator, the most critical task is to cultivate the habits of disciplined analysis and emotionless execution. Subscribe to this channel and return often to reinforce these foundational principles. Let this be the place you come to forge the habits that will define your future. The antithesis to Livermore's speculative chaos came from a man who experienced the 1929 crash not as a profitable short sale, but as a devastating financial blow. Benjamin Graham witnessed firsthand the destruction wrought by a market detached from reality, and he dedicated his life to creating a new paradigm. His entire philosophy was a direct intellectual rebuttal to the world of Livermore. If Livermore's question was, "Where is the price going?" Graham's was, "What is the business worth?" This shift from prediction to valuation was a revolution in thought. Graham's mission was to make investing safe, to transform it from a game of chance into a profession governed by quantifiable principles and rigorous analysis, a fortress against the market's emotional madness. He saw the Depression as the ultimate proof that speculation, undisciplined by value, leads to ruin. The absolute cornerstone of his intellectual fortress was the margin of safety. This was his non-negotiable principle, the bedrock of his every decision. It is the simple but profound idea that one should only buy a security when its market price is significantly below its calculated intrinsic value. This discount was not for generating higher returns. Its primary purpose was to provide a buffer against error, bad luck, or the extreme volatility of the market. To illustrate this, Graham introduced the allegory of Mr. Market, his most enduring teaching tool. He posited the market as a manic-depressive business partner who offers you a different price for your shares every day, driven by his mood. The investor's job is not to be influenced by his moods, but to exploit them, to buy from him when he is pessimistic and offering absurdly low prices, and to sell to him when he is euphoric. This was a profound inversion of the speculator's mindset. It turned volatility from a source of fear into a source of opportunity. Graham's strategy was a direct contradiction to Livermore's at every turn. Where Livermore bought on breakouts to new highs, Graham bought on declines to new lows. Where Livermore studied the chart, Graham studied the balance sheet. Where Livermore embraced risk and sought to manage it, Graham sought to eliminate it. In his seminal work, The Intelligent Investor, Graham bifurcated his approach for two types of investors. The defensive investor was to stick to a rigid formula of diversification, buying only large, well-financed companies at a reasonable price-to-earnings ratio. The enterprising investor, however, could look for special situations and undervalued assets. The purest form of this strategy was the net-net approach, where he would buy stocks for less than their net current asset value, literally paying less than the value of the company's cash and receivables after all liabilities had been paid. He famously called these cigar butt investments, finding a discarded cigar on the street with one free puff left in it. His Graham-Newman partnership excelled at finding these obscure, statistically cheap companies. A classic example was his investment in the Northern Pipeline Company, which was trading for $65 a share but held at least $95 per share in high-quality bonds. The market was completely ignoring the value of the assets on its books. Graham bought a large stake and agitated to have the company distribute the portfolio to shareholders, unlocking the value. This demonstrated his approach. Find the quantifiable value, buy it at a discount, and if necessary, force the value to be realized. While brilliant, this approach had a crucial limitation that would be challenged by the next generation. It was a strategy born of the Great Depression, designed to find bargains in the wreckage of a broken economy. It was far less effective at identifying the great innovative companies that would power the unprecedented economic boom of the post-war era. This limitation brings us to the next stage in the intellectual duel led by Philip Fisher. Operating in the vibrant, technologically innovative American economy of the 1950s and 60s, Fisher saw that Graham's purely quantitative cigar butt approach was systematically overlooking the most dynamic and profitable companies in the market. He did not refute Graham's core principle of safety, but he radically redefined the concept of value. His philosophy was a direct critique of Graham's limitations, arguing that it is far better to pay a fair price for a wonderful company than a wonderful price for a fair company. Fisher's strategy was to identify these truly exceptional businesses and hold them for the very long term, letting the power of their growth and innovation compound into a fortune. He believed that the time to sell a great company was almost never. To find these wonderful companies, Fisher developed a unique investigative technique he called the scuttlebutt method. This was a direct challenge to Graham's reliance on sterile, publicly available financial statements. Fisher believed that the most crucial information about a company's long-term prospects could not be found in its annual report. He became a corporate detective, spending weeks and months conducting a 360-degree investigation. He would speak to everyone he could find, not just management, but also competitors, to understand the company's weaknesses, customers to gauge product satisfaction and loyalty, suppliers to understand its position in the industry, and most revealingly, former employees to get an unfiltered view of the corporate culture. This qualitative deep dive was designed to answer the questions that financial statements could not. Does this company have a durable competitive advantage? Is its management team of the highest quality and integrity? Is it the leader in its field in research and development? He codified this approach in his famous 15 points, a checklist focused not on the cheapness of the stock, but on the quality of the underlying business. These points can be grouped into several key areas. First, functional factors, such as a company's commitment to R&D and the strength of its sales organization. Second, the people factor, assessing the quality, depth, and integrity of the management team. Third, business characteristics, looking for high profit margins and a strong return on capital. His investment in Motorola in 1955, which he held until his death in 2004, is a testament to his strategy. He used scuttlebutt to identify their leadership in semiconductor and communications technology, and had the conviction to hold through decades of volatility, generating a massive return. Another key example was his early investment in Texas Instruments. He saw a company that was not just a producer of transistors, but a hub of innovation with a forward-thinking management team. Fisher's legacy is the creation of a framework for growth investing, shifting the focus from what a company is worth now to what it can become. However, the qualitative nature of his approach left one final problem to be solved. How does one reconcile the quantitative safety of Graham with the qualitative growth of Fisher? How much precisely is a fair price for a wonderful company? The philosophies of Graham and Fisher represented two powerful but conflicting truths. Graham offered safety through quantitative bargains, while Fisher offered immense growth through qualitative excellence. The market was left with a central unresolved question. The resolution to this intellectual duel would be found in the partnership of our final two figures, Charlie Munger and Warren Buffett. Munger, a brilliant polymath, was the catalyst who provided the intellectual framework for a grand synthesis. His core strategic contribution was the concept of a latticework of mental models. Munger believes that to be a successful investor, one must understand the big ideas from all major disciplines: psychology, history, physics, biology, and so on. He argues that trying to understand the world through a single lens leads to a distorted view, like the man with only a hammer who sees every problem as a nail. It was Munger who used this multidisciplinary approach to formally solve the Graham-Fisher paradox. He convinced Buffett to abandon the last vestiges of the cigar butt approach with a single powerful argument. Over the long term, the return on an investment is inextricably tethered to the return on capital of the underlying business. Therefore, it is far better to buy a great business that can consistently compound its capital at 18% per year and pay a fair price for it, than to buy a mediocre business that compounds at 6% for a deep discount. The latter provides a one-time profit, while the former provides a lifetime of compounding wealth. The 1972 acquisition of See's Candies was the pivotal moment. Buffett, still operating in the Graham mold, balked at the price, which was a significant premium over the company's tangible assets. Munger persuaded him that the true value lay in the intangible assets, the brand's pricing power and the consumer psychology it commanded, which allowed it to generate high returns with minimal capital investment. This purchase fundamentally changed Berkshire Hathaway's trajectory, moving it from a liquidator of cheap assets to a permanent owner of wonderful businesses. Munger also introduced concepts like inversion, thinking about a problem backward to find solutions, and the importance of understanding psychological biases, like social proof and incentive-caused bias, long before behavioral finance became a popular field. Warren Buffett was the master executor who took this synthesized philosophy and built it into the single greatest wealth compounding machine in history. His mature strategy is the perfect fusion of the century-long intellectual debate. From Graham, he retained the paramount importance of the margin of safety, ensuring he never overpaid and always had a buffer against error. He also inherited Graham's personification of Mr. Market, which gives him the emotional fortitude to buy during panics and be cautious during booms. From Fisher and Munger, he embraced the focus on quality, seeking out businesses with deep, sustainable competitive advantages, or moats, and excellent management. He combined these philosophies into a single mandate: to buy wonderful businesses at fair prices. He then took this synthesized investment philosophy and supercharged it with a unique structural advantage: insurance float. By owning a collection of insurance companies, Berkshire Hathaway collects premiums from policyholders up front and pays claims later. In the interim, this massive, ever-growing pool of capital, the float, can be invested for Berkshire's benefit. As long as the insurance operations are run at a break-even or a profit, a combined ratio under 100, this float represents a long-term, interest-free loan from the world. This gave Buffett a permanent, self-replicating source of capital to deploy into his high-conviction ideas, amplifying his returns on an unprecedented scale. His famous investment in Coca-Cola in the late 1980s perfectly encapsulates his mature strategy. He saw a business that was temporarily cheap after the 1987 market crash, Graham's safety, but which possessed a globally dominant brand and simple, predictable economics, Fisher's quality, and an almost unbreakable psychological share of mind with consumers, Munger's models. He bought a huge stake and held it, allowing the power of compounding to work its magic for decades, funded by the ever-present engine of his insurance float. His legacy is the definitive proof that the greatest fortunes are built not by speculating on price swings, but by partnering with wonderful businesses and allowing the inexorable power of time to build wealth. In reviewing this intellectual duel, we see a clear and powerful progression. The focus of market analysis shifted from the ephemeral patterns on the ticker tape to the quantifiable assets on the balance sheet, to the qualitative strengths of the business, and finally, to a holistic understanding of the entire business ecosystem through a latticework of mental models. This was not merely a change in tactics. It was a fundamental transformation in the definition of what constitutes valuable information. For Jesse Livermore, operating in an era of manipulation and opaque reporting, the only truth was the raw data of price and volume. Information was immediate, actionable, and perishable. For Benjamin Graham, writing in the aftermath of a crash that exposed the fictions of the 1920s, truth resided in the audited, verifiable numbers of a company's financial statements. Information was a matter of accounting, a collection of tangible facts to be weighed and measured. Philip Fisher rejected this limitation, arguing that the most potent information lay outside the public record entirely. His scuttlebutt method sought a proprietary informational edge through diligent investigative journalism, understanding that a company's future could not be found in its past financials. Finally, the Munger and Buffett model synthesized all of these inputs, proposing that true information is not a single data point, but a deep, multidisciplinary understanding of a business's competitive advantages, its management's character, and its position within the broader economic and psychological landscape. This evolution in the nature of information directly corresponds to an evolution in the concept of time. Livermore's operational horizon was measured in weeks and months, the lifespan of a single powerful trend. Graham extended this horizon to several years, the time it typically took for a statistically undervalued stock to revert to its intrinsic value. Fisher introduced a radical new idea. The ideal holding period for a truly outstanding company was, in his words, forever. This was the intellectual leap that unlocked the true engine of wealth creation. The source of returns was no longer seen as merely capturing a mispricing or a short-term trend, but as participating in the long-term value-creating power of a superior business. This represents the market's own maturation, from a speculative arena for operators to a compounding machine for owners. The methods changed dramatically, from the fast-paced, high-leverage trades of a lone speculator to the patient, decades-long capital allocation of a corporate entity. The objective shifted from seeking short-term speculative profits to building long-term durable wealth. Yet while the strategies and time horizons evolved, the fundamental requirements for success remained constant across every one of these figures. These timeless principles, the true bedrock of their fortunes, can be deconstructed into three core pillars: unwavering discipline, the courage of independent thought, and the mastery of emotional control. These are not personality traits one is born with. They are cultivated habits, forged through experience, study, and a relentless commitment to a rational process. The first pillar is unwavering discipline. This is the non-negotiable foundation of execution, without which even the most brilliant analysis is worthless. This discipline manifests in several critical forms. First is the discipline of preparation. It is the thousands of hours Livermore spent studying past market movements to recognize his pivotal points. It is the exhaustive, painstaking research Graham conducted into the fine print of financial statements to uncover hidden asset value. It is the relentless investigative work of Fisher's scuttlebutt method, tracking down every lead to build a complete picture of a company. These individuals did not act on whims. Their actions were the culmination of immense, often unseen, preparatory labor. Second is the discipline of patience. This is perhaps the most difficult form to master. It is the ability to sit in cash for months, as Livermore often did, waiting for the one perfect setup rather than chasing mediocre opportunities. It is the discipline of Graham or Klarman, watching a bull market rage while refusing to participate because no securities met their strict criteria for a margin of safety. It is the patience of Buffett, waiting for the fat pitch, the one investment idea so compelling that it warrants a massive commitment of capital. In a world that prizes constant action, these figures built their fortunes on strategic inaction. Finally, there is the discipline of execution. This is the courage to act on one's analysis without hesitation. It is the discipline of Livermore's 10% stop-loss rule, a reflexive, unemotional amputation of a losing trade. It is the discipline required to sell a beloved company when the fundamental story deteriorates, or to buy a hated asset when it becomes statistically cheap. This discipline is not born from blind faith, but from a deep, unshakable conviction in a well-reasoned and thoroughly tested process. The second pillar is the courage of independent thought. Every great fortune discussed here was the direct result of a viewpoint that was, at the time, deeply at odds with the prevailing consensus. This is not simply being a contrarian for the sake of being different. It is the ability to develop a thesis based on facts and sound reasoning, and then to hold that thesis with conviction, even when faced with the ridicule or indifference of the crowd. The market is a powerful machine for enforcing social proof. It is psychologically comfortable to own what everyone else owns, to believe what everyone else believes. However, the hard reality of markets is that by the time an idea is comfortable and widely accepted, the significant financial opportunity is almost always gone. The greatest returns are not found in the warm embrace of the consensus, but in the cold, uncomfortable loneliness of a variant perception. This is Livermore standing alone, building a massive short position against the euphoric roar of the late 1920s. It is Graham buying assets from the wreckage of the Great Depression, when the very idea of owning stocks was considered financial suicide. It is Buffett buying American Express during the salad oil scandal of 1963, when the market believed the company was facing bankruptcy, while his own scuttlebutt-style research showed that its core traveler's check business was unaffected. In each case, these figures did not predict the future. They simply analyzed the present more rationally and completely than their terrified or euphoric competitors, and had the fortitude to act on their conclusions. The third and final pillar is the mastery of emotional control. If discipline is the engine of execution and independent thought is the source of one's edge, then emotional mastery is the defensive armor that ensures survival. Every market participant, from the novice to the legend, is subject to the two primal destructive emotions that govern financial markets, fear and greed. The difference is that these legendary figures developed concrete systematic defenses against their own human nature. They understood that the war for financial success is fought not on the ticker tape, but in the 6 inches of space between one's ears. Greed was countered with a predefined sell discipline. For Graham, this was the rule to sell a stock once it reached its calculated intrinsic value, regardless of how much momentum it seemed to have. He was content to capture the value, leaving the speculative froth for others. For Livermore, the antidote was his strict rule against averaging down. He would never throw good money after bad in the hopeful belief that a losing trade would turn around. This prevented the small losses that are a natural part of trading from becoming catastrophic portfolio-destroying disasters. Fear was countered with an unshakable analytical framework. The ultimate tool against fear is Graham's margin of safety. By purchasing an asset for far less than it is worth, the investor creates a psychological buffer. Market panics and price declines become less terrifying when you know that the underlying value of your holdings is substantially higher than your purchase price. This is what gives an investor like Buffett the fortitude to deploy capital aggressively during a market crash. He is not being brave. He is being rational, capitalizing on the irrational fear of others. The Mr. Market allegory is the daily mental exercise for managing this emotional battle. By personifying the market as an irrational partner, the investor can detach from its moods, viewing its panic not as a signal of impending doom, but as a generous offer to buy valuable assets at a discount. In conclusion, the intellectual journey from Livermore to Buffett is more than just a history of finance. It is a profound lesson in the development of a rational, robust, and repeatable approach to building wealth in a chaotic system. The evolution from analyzing price patterns to owning businesses represents a triumph of long-term thinking over short-term impulse. But the enduring legacy of these figures is the set of timeless principles they all shared. The ultimate lesson from this journey is that building a fortune in the market is less about finding a secret formula and more about building a superior character. It requires the relentless discipline of a professional, the intellectual honesty to challenge one's own biases, the courage to stand apart from the crowd, and the profound emotional fortitude to master the primal impulses of fear and greed. The path forward for any serious market participant is not to simply copy the trades of these individuals, but to strive to emulate the characteristics that made them successful. Their patience, their discipline, and their unwavering commitment to an independently derived and rigorously tested philosophy.